two major types of accounts or categories of accounts are a checking account and a savings account. The difference between a checking account and a savings account is that the checking account allows you to transfer funds in and out of it. Most of them don't have limits. Some checking accounts do have limits as to the number of transactions that you can have in a month, but those are really not very common. Whereas a savings account has definite limits as to how many withdrawals can be made. You can put in as many deposits into a savings account as you want, but there are limits to how many withdrawals you can make. So savings accounts aren't good for paying your bills because most of them say you can make like 3 withdrawals in a month. That's it. So the idea behind a savings account is the banks count on that money being in there because that's how they make their money. Whereas a checking account, the banks don't count on that money being in there because they know that's a fluid account. So money can go in and out pretty much unlimited per month, unless it's a certain account that sets limits, but most of them do not. The check is the written order telling the bank to pay money to the account of the check holder. So that's what a check is. It's a written order, and the numbers on it are your bank number, your account number, and the check number are on the numbers on the bottom, and we'll go over that and I'll show you how to read that. And then you have an electronic funds transfer, which is an electronic check essentially. And as you, I'm sure, know, we're moving away from paper checks and towards everything being electronic. Those of you that had checking accounts, have you ever written a check? Anybody ever written a check? Okay, you have? All right, well, you're going to write one in here because I'm going to make you, but it's not very common anymore to write checks because most things are moving towards just all electronic. You know, you pay your bills online, you use your debit card, everything's electronic. The payee is the person being paid, so the receiver of the funds. So when you pay your rent, your apartment complex or whatever, they're the payee. And you are the drawer because you're not the payer. But essentially that's what you are. You're the payer of funds. It's called the drawer. And it's called the drawer because that's where the money is coming out of. Okay, check clearing is what happens when there's enough money in the account and the check has been paid. It's called cleared. The opposite of that is when there's not enough money and the check is not paid and that's bounced, or okay, well, you'll see NSF for insufficient funds. Okay. The deposit slip is a slip of paper that you fill out to make a physical deposit at a bank. Some banks don't require deposit slips anymore if you're depositing a check because you sign the back of it. And ATMs typically don't require deposit slips anymore, although they used to. But that's because the old ATM machines didn't take cash. Like, you guys know how you put a cash in an ATM machine now and it just like sucks it in and counts it? Back in the day, you had to stick the cash in an envelope and the envelope went in, so it had to have a deposit slip because it stamped the envelope. And anyway, direct deposits made electronically into your account. They're validated before your funds are released, and these are usually like a paycheck or a government check. For example, if I wanted to write you a check, I don't have the ability to have it direct deposited into your account. I'm not set up for that. I'm just a person. A hold is what a bank will put on a deposit until the funds clear. Typically, if you look up your account information, you will see pending balance or pending funds if there's a hold put on the account. There's a couple different kinds of holds. There's like a hold that they put on a check maybe because it's a large amount and they want to make sure it clears. And so the hold will just be until the check clears. some holds have set numbers of days. For example, if you have like an out-of-state check that you're depositing for a certain amount or some above a certain amount, the bank may just put a 7-day hold on it, period, or a 3-day hold on it, period, 10-day hold. It depends on your bank policies as to how long the hold is, and which, like I know my bank has, if a check that you're depositing is above a certain amount, then they put a hold on it for 7 days, no matter what. If it actually clears before 7 days, oh well, they're just gonna sit there until 7 days are up. Okay, endorsing. A bank is not legally allowed to do anything with your check unless it's been endorsed by the payee. So you either sign the back of it like by hand, or you put like a for deposit only stamp on the back of it with the account number, or you can do an electronic signature for like an electronic direct deposit, things like that. So for example, if your paycheck is direct deposited, when you filled out that direct deposit paperwork, you authorized an electronic signature for that to happen. Okay, once a check has been paid, it's canceled. If you've looked at checks, you'll see they have a number in the top right-hand corner. That's the check number. And when you order checks for your own account, it's important to keep track of what your check number you're on, because they come in lots of 50. So like if you had checks numbers 200 to 250, then the next set of checks you order need to start with 251, because a check can only be processed one time. And so if you get the numbers wrong and you order checks 200 through 250 again and you start writing them, as far as the bank's concerned, that check has already been written. You can't use it again. So those numbers are important in that top corner. The check can only be processed the one time. Okay. Insufficient funds is what happens when you don't have enough money in your account to cover the check, and it's returned dishonored, it bounces. And then there are fees. Big fees, lots of fees. Okay, and depending on your bank, the fees can snowball, and you can end up with like a really negative account really fast. I know some banks, if you, let's say you bounce a check and so your account goes negative, because they charge you the NSF fee, which is usually about $35. And then some bank will let you be negative for a few days, and then they start charging you a daily fee for being negative. So every day you're negative, you go more and more negative, which makes it harder to catch up, right? So you want to be aware of all that before you open accounts at banks. Look at their fee structure. Okay, you can get overdraft protection. Overdraft protection pays the check even if you don't have enough funds. Again, you get charged a fee, but it's usually like a lesser fee, like $10 or $15, and the check is paid. So, you know, you don't end up with somebody calling you being like, oh, your check bounced, you need to come pay us this money and this fee and everything else. Now, there's two types. There's from a savings account. So if you write a check for more money than you have, they take the money out of your savings account to pay the check. Or there's through a credit line. Now, you have to have good credit to get the kind that goes through a credit line, but if you overdraft, they put that amount on a credit line and then they charge you interest. So you'd want to pay it really fast so you don't get charged too much interest. So there's the two types of overdraft protection. You guys all know what ATMs are. I don't need to explain the ATM to you, right? And you know, if you use one from a bank that's not your bank, you get charged double fees, because your bank will charge you a fee for using the non-bank ATM, and then that ATM will also charge you a fee. Usually you get double fees that way. So if you have, let's say, for example, a Bank of America bank account, go to Bank of America ATMs only, and then you don't have to worry about it. And your PIN is your personal identification number, and it's for security purposes to make sure that any Yahoo off the street can't withdraw money from your account just because they find your card. Yes, sweetie?
So at a Bank of America, when
Yeah, the ATM machines, I can go to any ATM machine in the world and put my bank card in it and get money out. If I go to an ATM machine that is not my bank account, like, or my bank branch. So for me, because I have a credit union, I can go to any credit union ATM and that's okay. Because credit unions are on the same network together and they don't charge fees for using other credit union ATMs. But if I go to, say, a Wells Fargo ATM, and I'm sure you've seen this when you go to an ATM and you put your card in and it says there's going to be a fee of $1.50 or something. Wells Fargo is charging me a fee to use their money because then they have to process it and get the money back from my bank to fill up back their ATM. So they charge me a fee. Well, then usually what will happen is my own bank will also charge me a fee for using another bank's ATM because they have to go through the process of sending that bank the money. So a lot of times if you use an ATM machine that's not from your bank, you get double fees. Not always. It just depends on the banks. It depends on the bank where the ATM is that you're going, and it depends on your own bank's policies. What I recommend is, so we started the checking account chapter yesterday. We came back out of town, which will sound weird because it's going to be all in one video, so it's going to be weird for anybody else that's listening. All right, so on checking accounts, some accounts charge maintenance fees. And what these are your monthly fee for the bank to maintain your account. Now, most checking accounts don't have fees, the majority of them, but some of them still do. And the reason being is that banks don't really earn a lot of money off of your checking account. They're not able to loan out that money because the anticipation is that it's not going to be there very long. So they'll charge a maintenance fee. Some accounts have no fees at all. Some accounts will waive the fee if certain conditions are met. For example, you keep a monthly or a minimum deposit in there that you never go below. Again, when you open a bank account, this will be in the information that you get the paperwork, and you want to read and find out if you have a monthly fee or not, and if there are conditions for not having a monthly fee. For example, in my credit union, one of the conditions of not having a monthly fee is that I have to make at least one bill pay payment per month. Don't know why, but I have to go into the bank and pay a bill through the bank once a month, or else I get charged a monthly fee. So I just do that. But if I didn't know that, I'd be getting charged a fee. Interest. You're talking about interest, you can either earn interest or you can pay interest. In a checking account or savings account, the idea is to earn interest. And interest is a percentage paid on the account balance. Over a given period of time, you can earn monthly interest or maybe annual interest, and they take the average balance for that period of time and they pay interest on it. Most checking accounts do not pay interest. Yeah. Minimum, yeah. Okay. Most checking accounts do not pay interest. The ones that do pay interest generally require that you maintain a minimum balance of some sort. And that will depend on the bank. Some may require a minimum balance of $100, some may require a minimum balance of $5,000. There's really, it's up to the bank and the particular type of account you're looking at.
Paying the bank, is that what like it is?
What?
Paying the bank?
No, interest, this is earning interest into your account.
Sorry, I just don't understand what interest means. Like I'm
You
trying
can either earn interest or you can pay interest. Okay, so if you have a savings account, for example, and you keep money in the account and you're not taking it out, what happens is savings accounts are meant for long-term savings. They're not meant for just temporary. They're meant for years. And so you keep putting money in is the idea. And then the bank has that money just sitting in an account. Well, what they do is they actually loan other people that money. And they charge interest on the loan. But then what happens is they pay you interest for the right to use your money.
Oh.
Okay? So on some checking accounts pay interest also for the right to use your money. But usually those are very specific checking accounts with like minimum balances and things. The checking accounts that are the most regular checking accounts don't pay interest, but you also don't have a required minimum balance and stuff like that. So if you have money in a bank account or somebody's using your money, you earn interest. If you borrow money, you pay interest. Is that better? Okay. So in this instance, since we're talking about checking accounts, is interest that you could possibly earn. The money you have to pay to the bank for your checking account is if they have what's called the monthly maintenance fee. You may have to pay for that. And then any other fees if you have an insufficient funds or if you have an overdraft or if you have to go into the bank and have them print you a cashier's check. They'll charge fees for that kind of thing. But that's not interest, that's just like set fees. Your basic checking account, this is what most people have. It's near like no frills, no interest, no limits on the number of transactions you can have. You can write as many checks as you want as long as there's money still in the account. You transfer money in and out, no problems, but you're not going to get interest. And some of the basic checking accounts are free and some have minimum or monthly maintenance fees. Interest-bearing checking accounts pay interest. They usually pay it monthly, some pay it annually. They usually require a minimum balance to be maintained. So in order to earn that interest and keep the account open, you have to keep a certain set number of dollars in the account at all times. And the bank decides what that amount is. And then if you go below that balance, you get charged fees, penalties for doing that. Free checking accounts have no minimum balance and they charge no monthly fees. However, this does not mean that they charge no fees. They can still charge fees for overdrafting, for insufficient funds, for getting a cashier's check or things to order checks. Those cost money, but they can't charge you a monthly fee. And the Federal Truth in Savings Act is your legal protection for this. So if your bank tells you it's a free checking account and they start charging you a monthly fee, then what they're doing is illegal based off of this federal law. If they say it's free, it has to be free. They can't charge you a monthly fee. They can't make you keep a minimum balance. That's not that they can't charge you any fees. They can charge you for things that you do, but they can't charge you just for the existence of the account. You can have a joint checking account here at the top or a single account at the bottom. A joint checking account is when more than one person's name is on the account. That can be 2, 3, 4, really kind of however many you want. And when more than one person's name is on the account, everyone has equal access to the account and equal liability. So should you have a joint checking account with other members of your family, any one of you could walk into the bank and take money out or put money in. And then let's say your cousin George is on your account and he bounces a check. And the bank comes to you and says, hey, you owe us this money for this bounced check. You can't be like, no, George wrote that check. They don't care. You guys all have equal liability. So equal access to the money, equal liability should there be fees or charges or anything like that. So all equal. There's not like a hierarchy of who has the more rights to the money or anything like that. There are accounts called express checking accounts. These are electronic only accounts. Deposit or banking needs to be done via the internet, ATM machines, or the phone, including smartphones. You actually, if you have an express checking account, you actually get charged money If you go in the bank and talk to a live person, you get charged a fee for that. You're only allowed to do electronic banking with these. So you're not allowed to actually talk to a human being ever, or you get charged. There's a type of account called a NOW account. NOW stands for negotiable order withdrawal, and that's a type of a free checking account that pays interest. Some banks offer NOW accounts, some don't. Just depends on the bank. There's Lifeline checking accounts. These aren't as necessary so much anymore because there's so many free accounts out there now. But even 10 years ago, free checking accounts weren't very common. Most checking accounts had fees. And so the government set up this program, the Lifeline program. You guys may have heard of Lifeline telephone services and things where you get free 200 minutes on your cell phone a month. Okay. Well, these accounts are based on low income. So Lifeline, cell phone, Lifeline, electricity, Lifeline, banking. It's a program that was created. So if you qualified low income, you could get this free account that has lower fees. So if you do hit a fee, it's not as much as a regular checking account. So if an insufficient funds fee was $35 at one bank, it might be, the Lifeline account might be $20 instead. But you have to qualify on those income dates. And then you have your single account, which is also an individual or a sole owner account, and only one person has legal access to the account. So if you're the only person on the name with your name on the checking account, if you're in an individual account. If you and your cousin have an account together, it's a joint account. Questions about that? Alrighty, check registers. Lots of people don't keep these anymore, but my advice is you really should. Your check register you can be on your phone. If you have a smartphone, you have a program, check register program. It can be on your computer, it can be a piece of paper book. But the register is your own record that you keep, that you write down, of all of the transactions, money going in and out of your account. Every purchase, every bill you pay, every deposit you make, and you include the date, the type of transaction, and the details as to who it was paid to or where it came from. And the reason you want to keep this is because it gives you, first of all, a running balance of your account, so you know exactly how much money you have at any one time. But it also gives you a way to check for errors. And those errors could be yours, or they could be the bank's. Most checking, well, all checking accounts are on my computer, but that doesn't mean there can't be errors. And those can be errors from a calculation error, or an omission, or a transaction that went through your account that you didn't do. But if you don't have your register, and you look on there and go, Taco Bell for $8. I don't remember going to Taco Bell for $8. Well, I guess I must have. Maybe you didn't. But how would you know? Things like that. It was 2 weeks ago. You might not remember. But the register, to keep a running account, you always can catch those mistakes. Debits is money coming out of your account. So purchases, withdrawals, payments, and that could be through a check or your ATM card or debit card, automatic bill pay, whatever. Any money that comes out of your account is a debit, and any money that goes into your account is a credit. So that could be deposits, interest, refunds, anything like that. Your basic deposit slip looks like this. Some banks, they're longer, some banks they're shorter, and some banks they have the account number will be boxes that you fill in, so one digit per box. But essentially it looks like this, especially this part here. Those pretty much all look the same. And you have your cash, You have your checks, which you have to list individually, and then your subtotal, and then if you're getting cash back, so like you're depositing 6 checks and you want $50 cash back, you put that there, and then the actual total is deposit. So Allison currently has a balance of $2,300 in her checking account. She is depositing a paycheck, a rebate check, and a personal check. She wants to receive $200 in cash, and we want to know how much will she have in her account after the transaction. Okay, to fill one of these out, we put in the date and her name, and we don't know her last name, so she's Allison Doe. Well, let's give her an account number. Very creative with my account number there. Okay, and her bank is the Money Bank in Cashton, North Carolina. Okay. She's not depositing any cash. So this part we leave blank. Her first check is $425.33. Dollars and cents. Her second check is $20. Her next check is $550. And she wants $200 back. So what I'm going to do is I'm going to add up the deposits. So we're depositing $995.33 worth of checks. You guys want to double check me? Did I miss anything? She wants to take $200 cash out, so her net deposit is $795.33. So these get added, that gets subtracted. Now the question asks us how much will she have in her account after the transaction. Well, she had $2,300. She's depositing $795.33. Which gives her a new balance $3,095.33. Any questions about that? Check registers, the way you set them up is kind of personal. You'll see how there's kind of like a shading that splits this big line into 2 lines. Some people write in like once in the big line, and some people write like a transaction, like 2 transactions, one on the light part and one on the shaded part to take up less space. It kind of just depends on you and your handwriting and your own personal. I do this for my adding and subtracting because I write it in on the other side on that second line inside the big line. But again, that's up to you. As for your item number, over here in this column is where you put the check number if you're writing a check. And that's really important to keep track of because you want to know which check you wrote to which company or person. If not the check number, then you can put like an abbreviation for the type. Okay, in this case, this is an E. Oh, I can't write there. E for electronic. But, you know, you might do like if you have like a debit card Visa, you might do like V for Visa or D for debit card. I usually don't do D for debit card though, because I usually do D for deposit. So, you know, it just depends on what you guys do. Like here, I could put DEP for deposit. And here I could put EFT for electronic funds transfer, or like if it's a Visa, you put V, you know, that's up to you to keep, you know, that a type of system that makes sense for yourself. But definitely check number. Second column is the date, also important because you need to know what date things happen so that when you go back to check your account and make sure everything's correct. If you paid, Star Cable on the 10th, it'll show up in your bank a couple days later. Well, if you have two transactions for this and one was dated before the 10th and one is dated after the 10th, one of them's wrong. Just, things like that. You need to have the date. Then you have the description of the transaction. So here we've got this auto body shop, and then in parentheses there were car repair. Just so they know what it was for. That's up to you too, however you want to keep track of this, but you definitely want to put the company or the person that it was paid to, and then if any other notes that you want. Like if I go online and I pay bills online, you know how you get the confirmation numbers when you pay things online? You know what I'm talking about? Even if you order something online and get a confirmation number, I write those in there. So that should something come up later and they don't have a record of my transaction, I can show like the confirmation number. Yes, this happened. This was paid. Or yes, you do have to send me those tickets. Just whatever. This column is for the amount of the payment or the withdrawal. Over here you put deposits and credits. You want to keep the withdrawals and the deposits separate because you don't want to add something you're supposed to subtract or subtract something you're supposed to add. This column here is for any bank fees. We talked yesterday about if you go to the ATM at a bank that's not your bank, you can get charged a fee for like $2 or whatever. That's what you would write here. And then this column, you see has like a little check mark. This is for after it's cleared. So once it's cleared, you check it off. So you know it's gone through your bank. That way, if, for example, I wrote this check for $1,000 up here, but let's be more realistic. I wrote this check for $138, but it hasn't cleared yet. When I look at the money in my account, I'll go, ooh, I got all this money, I can go shopping. Because it's actually already been, it just hasn't cleared yet. So I know that the money that my bank is saying I have is actually less than what, what I really have is less because that just hasn't gone through. Okay. So, we've got mixed account and we have mixed transactions, and we are going to figure out what mixed balance is. Everything from here gets subtracted. Everything from here gets added. And like I said, I do the 2-line thing because I like to keep a running total. And I like to do this. I'm going to put my balance in, but you don't have to do that. But I've got 3672 minus 1721 so that leaves 195,127. And then from there, I'm going to subtract the 3250. Which is 1918.77. And from there, I'm going to add 821.53. So that's our deposit. And then I subtract 101.50. And I'm going to subtract 138.90. And Nick has $2,499.90. I again, you don't have to write these in on your own check register. A lot of people don't. I'm for sure writing them in on here to show the process that I went through, so there's not just some list of numbers and you don't know how I got them. And I write them in on my accounts because that helps me find mistakes if I did mistakes in the calculations. Okay, reconciling a bank statement is the technical way. I mean, that's like the technical terms, but really it's balancing your checkbook. And what that means is you take the information that the bank has from your monthly bank statement, and you compare it to the information you have from your check register, and you make sure everything balances and there are no mistakes on either person, either your end or the bank's end. Okay. Your account number is a unique identifier. It'll appear on your checks, your deposit slips, your bank statement, basically any paperwork associated with your bank account will have your account number on it. They identify people via account number and not names because, well, more than one person in the world will probably have your name. Anybody think that they have the only person named your name? Really? Bet you I'll find one. I'll have to look. There's a website where you can actually look up how many people are named your name in the United States. There are 9 Susan Aitons. So there's the website. You can see exactly how many, like hundreds of people have your name. So there are 9 Susan Aitons, and I'm only directly related to one of them.
What website is this?
I'll look again. I'll find it. So that's why you have your account number and not your name. Your bank statement is the monthly statement of all transactions that have occurred in that time period, and that time period is about a month. Either like a legitimate month, so the first until the last day of the month, whether that's the 28th, the 30th, or the 31st, or it could be like a 4-week period. Most banks do an actual month, first through the 28th or the 30th or the 31st. And the statement is everything that has occurred at the bank during that time, not necessarily everything that you did during that time, because some transactions lag. So if I go out on the 29th and I write a check, and then they print out the bank statement at the end of the day on the 30th, that check's not going to show up yet because it won't have had time to process.
Initially a record of the bank.
Yeah, it's the bank's records of what happened in your account. Yeah, the first is the check register, which would be your record of what's happening in your account. Now, this can be paper or electronic. That is actually something you get to choose. Bless you. You can have a paper statement mailed to your house, or you just pull up an electronic statement by logging into your bank account if you want to see it truthful. Your starting balance is the account balance at the start of the day. So whatever time the business day is for the bank, be that like 8 or 9, whatever balance you had in the account at like 8 a.m. on the 1st is your starting balance. Your ending balance is the amount of money in the account at the end of the day on the last day of the statement. So if the last day of the statement is the 30th, the ending balance is when the bank is closing that day. And what they do is they process the statements overnight because no transactions occur, and then they mail them like the next day or post them on your account online. Outstanding deposits are deposits that you've made. If you've actually put the money in the bank, but they haven't shown up on the statement yet. And again, sometimes there's a lag time. I make a deposit on the 30th after 2 p.m. Even though they process the bank statement on the 30th, my deposit won't show up yet because it won't clear until the following business day. So that would be an outstanding deposit. deposit. Or if I make a deposit on the 1st, and then like 2 or 3 days later, I get a statement in the mail from the previous month, that's still not gonna show up yet because the mail got sent out the same day I made the deposit, so of course it would be on the paper. Does that make sense? So outstanding checks are like outstanding deposits. These are checks that you have written, or, and when you say checks, it's not just checks. This can be any debit. You know, so an ATM transaction, online bill pay, you know, anything like that that you've made, so money that has come out of your account, withdrawals, that haven't yet shown up on the bank statement. So again, sometimes there's a lag. I write a check to pay my electric bill on the 24th, and I mail it. It takes a couple days to get to the electric company, and then they have to deposit in their bank, and then it takes a couple days to come out of my bank, and it might not show up on the statement yet. Yeah.
What's that word right there, after account, on the statement?
Account activity.
Okay.
So sometimes, even though you know you spent the money, it won't show up on your statement yet, even if you did it several days before the end of the billing period, just because of mailing time and bank processing time, and these things take a little while. Balancing the checkbook is you compare your records and the bank's records, and you are making sure that no errors have been made, and that everything balances. It's basically know how much money you have. So here's what a basic statement looks like. And the format of statements can be very different depending on the bank. Some of them will have, you know, like more of an Excel spreadsheet looking with lines and grid marks, and some of them have long lists, and some of them separate deposits and withdrawals into different sections, and it just depends. But your basic idea, you're gonna have your information at the top and your account number and a statement period and a starting balance. They're going to give you a list of the deposits that have come into the account, and they're going to give you a list of the withdrawals that have come out of the account. The description might be more than this. It might just, the WD stands for withdrawal. But it could say, you know, like if this check 1770 was written to PG&E, it might say PG&E here, or it might say check, or, you know, there's some sort of description from the bank. And then, of course, the transaction amounts, and if there are check numbers, there'll be check numbers here. If you did like a debit, there won't be a check number. Typo. Somewhere on here, you'll also have the ending balance. So you'll have a starting balance of some money, and then you'll have an ending balance, which in this case needs to be 628.23. So again, the starting balance will just say it was like, I don't know, 1 million, no, just some numbers. On there, you'll have your starting balance, and they'll have an ending balance, which is the balance the bank had on this day, at the end of the day. Okay, we're going to use this information, this very short bank statement, and the check register on the next page to balance the checkbook. Okay? So first what we do is let's look at the check register. Okay, we have our transaction numbers down the side here, check numbers, the dates that they occurred. Now the date that you did the transaction and the date that'll show up on the bank statement are not the same date, because, well, sometimes they are, but sometimes they're not. Like a check takes a couple days, so it'll be a few day lag. And then like a Visa would go through the same day, so it just depends. You have your descriptions, the money coming out of the account, the money going into the account, and then the running total. Now you'll notice there's a couple check marks here. These things have already cleared. Okay, so we don't have to account for them. Those are from the last statement. They were taken care of already. So what you do is you look at the bank statement and you check off everything that's on there. Okay, so that's step one. Go over here first. Check off transactions. Okay, so I have deposit for 35 first. So I'm going to find a deposit for $35 here. I'm going to check it off. It's been accounted for in the bank statement. Then the next thing I have is another deposit for $100. Deposit for $100 up here that was already checked off. We have another deposit for $100 here that's not checked off yet. This is the one we want to do. This one was from the last statement. Okay, so we check that off. Then I have check 1770 for $158. 1770. Check the amount 158.08. They match. You always want to do that too and make sure that the amount that the bank has and the amount that you wrote down are the same. Okay. I have check 1768 for $46.50. So 1768, $46.50, that matches. So I check it off. 1769 for $74.64. 69, 74.64. Check that off. And then last 1763 for 19.50. That goes up here. Okay, those are the things that are on the bank statement. So that's the first thing you want to do. Okay. The next thing that you want to do is you want to calculate the outstanding withdrawals. And there's just the outstanding checks. Okay. So we go through and I'm going to highlight it, but you don't, like in your own register, you probably wouldn't highlight it, but I'm going to highlight it here. Okay, anything that didn't clear yet is an outstanding check. I want to add those up. So I have a $50, an $18, $29.10, and a $15. Okay, so I add those up, and there's $112.10 outstanding. Okay. Then the next thing I want to do is I want to add up the outstanding deposits. So these are deposits that have been made that didn't show up on the statement yet. That one's checked off, this one's checked off, this one's checked off, so I only have one that's not checked off. So that was really easy to add up. So you've checked off everything that's on the statement. You add up all of the checks and debit card and ATM or whatever that are outstanding. And you add up the deposits that are outstanding. Then you perform some calculations where you take the ending balance of the statement. Okay. You add outstanding deposits. And you subtract outstanding withdrawals. And what you get is what's called revised balance. Okay. This ending balance came from the statement. So just write that from the statement. Okay. So remember how I said there was a typo and I didn't put the ending balance on there? That's where we needed. So the ending balance was 628.23. So take 628.23. Okay. I add my outstanding deposits of 125. I subtract my outstanding withdrawals or checks for 112.10. And I get what is called the revised balance. This number and this number need to match. This number in your check register is the amount of money you think you have. This number on your revised balance is the amount of money that the bank will say you have once the checks and deposits clear. If these don't match, there's a problem because you're saying that you have a different amount of money than the bank is saying you have. At which point you need to go look for the mistake, which I'll show you how to do also. Any questions about what I did here? Basically, I brought the bank's total up to date, like I moved it forward in time to today by putting in the extra withdrawals and deposits to figure out where it should be. I'm going to show you an algebra equation for this. So what you do is you call the statement ending balance call it A. And then you call the total deposits outstanding actually, you know what, let's not call it A, let's call it E so it makes more sense. E, we'll call this D for deposits. We'll call this W for withdrawals. Okay. So if you do E plus D minus W, you get the revised statement balance, which should match the register balance. Okay, so that's the formula. If we look at number 14, we've got information from their checking account statement and their check registers. Okay, this is, this is from the statement. These are from their registers. Okay, so this came from their bank. Then they checked off all the transactions that were listed, came up with outstanding deposits of 610 and outstanding checks of 471.19. We have their check register balance here at the bottom, and we're going to see, using just that formula we just did, will this match? We add the deposits, we subtract the checks outstanding, and that will give us the revised balance. So we take 725.21, oops, sorry, 71, add 610 and subtract 471.19. And we get 864.52. Does that balance? Yes. Now you guys try that one and tell me if it balances. When you look at your own check register, okay? We got a revised statement balance of 181.95. We needed 210.10. We need to go in now and figure out what happened. The best way to figure that out is you take your revised statement balance and your check register balance and you subtract them. Okay, so if I do that, 210.10 minus 181.95, that's a $28.15 difference. Most likely, the transaction, one transaction for this amount, is what's causing that. And since the register says that I have more money than I actually, the bank says I have, this is either like a purchase or something not written down. Or it could be a bank error. Oh, what did I do there? Okay. So what you need to do, if you find this, is you figure out how much you're off, and then you go look back in the bank statement, and you look back in your check register and see if you can find it. Sometimes it's just a calculation error. Maybe this $28.15 transaction was in your register, and maybe you checked it off, but maybe you didn't subtract it when you were going down the side. Something happened. You know, so you look for that amount. If you can't find that specific amount, you try to find maybe there's one or two transactions that would add up to that amount. That's how you start to look for the error. Most often it's a single transaction like that maybe just didn't get written down or just didn't get subtracted, or maybe you transposed the numbers on something and it made a $28 difference. Okay, we're gonna reconcile this bank statement, so I just want to show you guys another one of these. Okay, first thing I have to do is I go through and check these all off. So I have 1502 for 147.28. That's good. 1501 for 130. A deposit for 749. 1504 for 250. 1503 for 72. And 1505 for 26. So far okay? Our outstanding deposits, I'm just going to call them OD. Right there, $150. Our outstanding withdrawals, right there. $132. And then we're going to take our ending balance, add our deposits, subtract our withdrawals to get our revised statement balance. Our ending balance is here. Okay. I'm going to subtract, so I'm going to add my deposits, and I'm going to subtract my withdrawals. And I am going to get $1827.63. Needs to match. Matches so good.